we are now deciding, well, what are we going to do? Do we want to keep it? Do we want to bank in the next 2 years that she's going to die and at least we'll get our money back? So we pay an extra $11,000 in the next 2 years so that we can have some death benefit. I hate this kind of situation. I truly do not like it. It is my least favorite topic to ever talk about because I feel like we're playing Russian roulette with somebody's life. Do we bank on the fact that you die and we keep it? Or do we get rid of it hoping you don't die anytime soon and that we just cut our losses? Hello, and welcome back to the podcast. Thank you very much for being here. All right, today, this was perfect timing. I needed a subject to talk about today, and this just landed in my lap, pretty much like it does on a weekly basis. However, this is a really good one. So I have a client whose mom and dad own a policy on grandma. And that I don't know what the intent of the policy is, I'm assuming so that they can buy the farm and they're going to have death benefit for estate planning or something of the nature. But they were sold universal life policies. And so I want to share with you. So if you guys are not watching on YouTube or you are not watching on Spotify, because the video gets uploaded to Spotify. So if you're just listening, go ahead and listen. But if you want to actually see these so that you can protect yourself or somebody you know, then go ahead and watch it online. So I'm going to share my screen today because I want you guys to see what these notifications look like and what's actually happening inside these policies that are universal life. Now, one of them's a variable universal, I believe, and the other one's universal. Maybe they're both universal, whatever. They're universal type products. And so I want you to see what happens because I warn you all the time and I kind of feel like I'm, Chicken Little and the sky is falling and beware and beware and beware. And the reason I say that is because in the 16 years that I've done this, I've seen 3 decent universal life policies. Okay, they just don't exist because of the fees and the charges. And this is going to prove that. So let me share my screen so that you guys can see exactly what this looks like. So as you can see, I've blocked out the company name, I blocked out the agent's name, I've blocked out the client's name, obviously. And so I want you just to look. If you just, and I have this in the book. It's almost exactly the numbers in the book or the setup of the one that I have pictured in the book is very similar to this. So here you can see that it's universal life and that is a guaranteed UL2. Okay. This policy is going to lapse. So there is not going to be a policy in 2 years. They have included an in-force illustration with this. When they sent this letter, they included the illustration that said there's not going to be any policy in 2 years. Now, with that being said, with the in-force illustration, it also shows that there is no money in the policy now. So they have a guaranteed insurability or a guaranteed rider on here that the death benefit's going to go to 96. This is like a 15-year policy. And so here's the other thing. Okay. They issued this when this client was 80 years old. Now, I shouldn't say I would never write a policy on anybody that's 80, but there has to be a really good reason to do that. Because if somebody is 80 and they're getting like a good rating, chances are they're going to live a long time. Now, this agent must have assumed that this person was going to be dead at 95 or 96. She'll be dead by then. We don't have to worry about it. Well, they're 90. They're going to be 94. Okay. And totally healthy and alert and all is good in the world. Could something happen? Yes, absolutely. But I do not plan for my clients to die at 95. If I'm going to sell you a policy, I'm going to do that and say, hey, what happens if you live to 100? We want to make sure that this death benefit doesn't get paid till 121 because I don't want you outliving this thing. So the agent should have, in my opinion, looked at this illustration and said, oh, look, it ends at 96. You're in pretty good health. You could very easily live another 15 years, right? Or another 16 years. So she is paying $55.48 a year in premium. So $5,548 a year in premium. Now, here is the kicker. There's no money left in this policy. And it shows premium load, $1,109. Cost of insurance, $88.25.88. Other expenses, $13.86. And there's surrender charges. So if they cancel this policy, they're going to hold an extra $2,000. The value on this policy is negative because they've paid in $55.48. They earned $6.61 of interest. That's what they made inside the policy. So we have a total of $5,500, but they took out $88.25, $1,109, and $13.86. They grabbed that from cash value. They're actually showing a beginning account balance of a negative $18,000. I've never seen that. I will be 100% honest. I have never seen a negative account balance. Now, maybe that's what she has in surrender charges that have to be paid. I've never seen it stated like that before, so that could be it. But what happens when your premium is $5,500, but your fees are $8,000, $9,000, $10,000, $11,000? You're $6,000 short, right? So now we have to go to cash value and we have to grab that because there's no place else to get it. You either have to pay more in to keep this thing going, which to the tune of probably $11,000. So you need to keep paying more in, or we got to decide what we're going to do with it. Because if grandma lives 2 more years, there's not a policy. So I did the math. If she pays $55.48 times 15, she will have paid in $83,220, and there will be a death benefit of $100,000 because this death benefit stays level. It does not grow like it does in whole life. So if she outlives this policy and this thing is gone in 2 years, then she just gave the insurance company $83,000 and nothing ever got paid out. This is the true definition of term insurance. Universal life is like renewable term insurance. So why? Like, this is proof. And this is not, this $88.25 for cost of insurance, that's going to go up every year that she gets older. The client did not send me past paperwork to see how badly this is increasing from 93 to 94 or from 92 to 93. All this is expensive term insurance, or it's really probably not even expensive term. It's just term. So we are now deciding, well, what are we going to do? Do we want to keep it? Do we want to bank in the next 2 years that she's going to die and at least we'll get our money back? So we pay an extra $11,000 in the next 2 years so that we can have some death benefit? I hate this kind of situation. I truly do not like it. It is my least favorite topic to ever talk about because I feel like we're playing Russian roulette with somebody's life. Do we bank on the fact that you die and we keep it? Or do we get rid of it hoping that you don't die anytime soon and that we just cut our losses? It's really a shitty situation. In my opinion, the policy should have never been sold to her at 80 years old. If you are selling somebody a policy at 80, thinking they're going to be dead in 10 years, probably not likely. If they've made it to 80, they're probably going to make it to 90. I'm not going to bank on it. I'm always going to look past age 100 because here's the deal. There used to be parties for people over 100 years old. Right? Oh, you turn 100 and we have a big party and you make the news and you make the newspaper and it's a big deal. Now people turn 100 every single day and it's not a big deal. Now it's a big deal when you turn 110. And so if you are getting annual statements and annual reports, save them, look at them. What are all these expenses over here in this column of values that says less? What are all these things that they're saying, hey, you got to pay for those. And if you're not paying out of pocket, we're going to take cash value to pay for those. And then when cash value ends up to be zero, then the policy is going to lapse. The cash value on this policy is zero. The only reason it's still alive is because there's a rider on the policy that is keeping it alive. Otherwise, it wouldn't be alive. Okay, the same family. So this policy got sold to grandma at 80. Grandma owns it. Grandma's the insured. This other policy, the son owns it and grandma is insured. But if you look, it says the net surrender, this is important grace period notice. Prompt action is needed to maintain your coverage. Oh my, this is the, oh my God, your policy is falling apart. You need to do something right away letter. This is typically what happens. We get these letters right before the policy is going to lapse. We don't give you a lot of time, but we give, we're nice enough to send the letter last minute. Probably the letter should have been sent 5 to 10 years ago, but never mind that. They're the hero. They're sending it, looks like about 30 days. So the net cash surrender value in your universal life policy is not sufficient to maintain coverage, and a no-lapse guarantee provision is not in effect. So let's break that apart. Cash surrender value is not sufficient to maintain coverage. What that means is there's not enough cash in the policy to cover all the expenses anymore. Okay? So now we're having to come to you because this thing has ate itself up. We're having to come to you and you're going to have to pay $2,075.34 a quarter going forward. A no-lapse guarantee provision is not in effect. So when they sell these universal life policies, they put a rider on there that is a no-lapse guarantee. So they're shitty policies. So what we're going to do is instead of selling you a good whole life policy, we're going to sell you the shitty policy with this rider on it that it won't lapse because we already know before we sell it, it's going to lapse. So now we've come up with a rider. How about you just buy whole life? Because they're guaranteed. Okay. So in order to maintain coverage, if you want to save this $125,000 of coverage, then we're going to need you to pay $2,075 instead of $500. It's tripled, right? No, that's 4 times more, not triple. Sorry. 4 times more. If you choose not to send in the required premium during the grace period, your policy will terminate at the end of the grace period without value. Okay? No cash value, which means no death benefit because no lapse guarantee rider is not on the policy. If you want to reinstate the policy outside the lapse period, then you're going to have to go through underwriting to make sure that you're healthy, and that can be done. Please note that payment must be made in full. A partial payment will not extend the length of the grace period nor prevent your policy from lapsing. Yeah, who doesn't have $2,000 laying around every quarter when they expected $500? I mean, come on. Like, we're not going to even allow you to go to monthly. So again, grandma's 94. Do we pay the $2,000 every quarter? And how many more quarters will she be alive? So here's what I told the insurer or the owner of the policy. I said, add up how much premium you've paid, because nothing on here tells me how long they've had the policy. So add up how much premium you've paid, and then how much death benefit you have. Is it still worthwhile to pay the premium? Because that's how I look at it. Okay, so I have to pay $2,075. If she dies in the next 5 years, then, she's 94. So if she dies in the next 5 to 6 years, will we pay in more than we're going to get back? Or are we going to pay this and basically we're going to get our money back? But is this $2,075 going to stay at $2,075? Or is that going to go up every year? Maybe because cost of insurance goes up every year, right? All these fees and charges are going up every single year. So something we have to look at is when we have these policies, what does your annual statement look like? What does your in-force illustration look like? The annual statement is very telling because that's where we're going to see how much these fees and these charges are going up every year. And keep them from year to year, because what's happening with cost of insurance? Once we get over 65, term insurance gets really expensive. This is a term chassis. So every year we're renewing that term insurance essentially. And how expensive is that going to get? So look at your statements. If you are listening to this and mom and dad have a universal life policy as an estate plan, and that is a way to buy out the siblings, that is a way to pass off death benefit to a business owner, whatever that looks like, if it does not say whole life, then call and get an in-force illustration. Get your annual statements. Pay attention to them. If you are 30 years old and you have a universal life policy, you're going to be like, oh, it's fine. It's not a big deal. And it very well may not be a big deal because your cost of insurance is going to be really cheap. You're young. But do we want to continue to add into a policy that we know later on is going to have some repercussions? So I wanted to share with you because I just don't want to be Chicken Little. I don't want to tell you the sky is falling, but I truly hate these conversations. I hate having to tell somebody, well, is she likely to die? When is she likely to die? Do we want to pay more premium? Do you have the money to pay more premium? Okay. I've seen these premiums go up to over $100,000 a year to save a policy. Astronomical. People do not have that kind of money sitting around. This was supposed to be locked in. This was supposed to be cheap. They were supposed to be doing you a favor. No favors done anywhere along the road, in my opinion. So if you have in-force illustrations and you want me to look at those, send them over. I'm happy to look at them. Somebody messaged me the other day and said, I'm a life insurance agent. Will you look at these for me? I just want to make sure I'm doing the right thing. I am not telling you how to do your business. And here's the thing. If you wrote this shit, then understand how to read it. Why should I tell you how to read your own stuff? Okay, quit selling it. Just quit selling it. I talked to some clients today that they had a whole life policy. The agent 1035'd their whole life into universal life. And now we have to look at the in-force illustrations on those universal life to see how good they are. Chances are he went from a good guaranteed product to a crappy product, and now they're going to go back to a good product. That's a massive amount of lost money, lost death benefit, lost time. Seriously, all because of a rate of return? That in this one policy I showed you, the rate of return looks like it's 3.5%. And in a universal life policy, that's guaranteed. They usually have a guaranteed rate of return. 3.5%, and it's still eating itself up. I mean, come on. So if you're an agent that you want me to do your business, don't bother messaging me because I'm not going to do it. If you are a client, you are an insured, and you want me to look at those, I will 100% look at them. I will be honest about them. If they're great, I'll tell you they're great, and I'm happy to see more than 3 of them in 16 years. If they're not great, I'm going to tell you how we can save them. I'll most likely want you to set up a meeting so that we can have a conversation because as you can see, I'm 20 minutes in and I just got started, my friends. There is so much here to talk about. So make sure that, if you get the in-force and you send it over, if it's really simple, great. Otherwise, expect me to maybe say, hey, let's talk about this in a meeting so I can explain more of what's happening. What was the point of the policy? All that good stuff. Okay. If you need anything, MaryJo at withoutthebank.com. Grab your Life Without the Bank book, Farming book, Nelson's book, get the whole bundle, and then set up your appointment. I am not out that far at the time of this recording, so things are getting closer. You don't have to wait 3 months, only a month and a half. So that's awesome. All right. Let me know if there's anything I can do to help. Otherwise, you guys have a fantastic rest of your day.